I started this channel in late 2021, mainly doing stock analysis videos, talking about stocks. So you guys ask me about stocks that I'm buying, stocks that I'm selling. But many of you guys enjoy my educational content videos where you actually learn something that you could potentially implement in your own investment journey, and you could save a lot of money learning from my mistakes that I learned the hard way, and I learned them by losing money. And you could save this money by watching a free video on YouTube and potentially implementing a lot of those tricks and strategies into your own investment strategy. So I'm gonna do another one today, and I'm mainly gonna talk about my first 1000% gainer, a 10 bagger that I had in just 3 years. It's a very interesting story. I'm gonna tell you how I found the stock and some common attributes to look for to potentially find stocks that could go up 10 to 100 times. And those kind of videos, they don't get a lot of views. So if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Now, this stock is Mama's Creations, ticker symbol MAMA. I started buying it at $1.74 in 2023, and I even shared it on YouTube at about $3. Now it's trading at almost $20, and it's up more than 1000% for me in under 3 years. Now, what's really interesting about this one is it doesn't really have an exciting story. It's not really AI, it's not Micron, it's not semiconductor, it's not some kind of a cyclical stock where the commodity went up a lot and you were at the right place at the right time, like with people that invested in Micron and they made a lot of money because, again, we had the memory shortage. This is not a shortage, none of those bottleneck stuff. It's just a simple investment that's actually in a very boring industry, and it's mainly a food company that makes meatballs. Now, newer investors would skip over those stocks because they believe they're boring. I mean, how could you make 1000% from a food company? They believe that you need something exciting. You need to invest in space, you need to invest in robotics, invest in AI, invest in something for the future, which is true, and I do a lot of that. But that doesn't really matter as much as the companies that you're buying, how much you're paying, and the management team that's running the company. If you buy SpaceX at 150 times sales, I don't care how amazing it is, you're likely going to lose money, especially if SpaceX doesn't execute. If you're buying that boring stock at 2 times sales and it's growing sales 40%, and it could do that for 10 or 15 years, you have about a 10 or 20 or 30 bagger. So this is much more important than the kind of company you're buying. And I took those kind of frameworks and I put them in a strategy, and I implemented it many more times than just with Mama. I did it with Hims, did it with Robinhood, and even with Alstors that I shared with you guys on YouTube. It's been doing really well. So I have a framework that works, and I'm going to share it in today's video. Now, I personally haven't really started by investing in growth and investing in quality companies and long-term investing. I wish I had, but I didn't. I was mainly influenced by Benjamin Graham's strategy of buying stocks that are really cheap on paper, below liquidation value, hated stocks, hated sectors. And once they reach fair value, I would sell them and I would move to the other one. So I never really had even a 2-bagger before that, or maybe a 3-bagger, because I would always sell stocks at fair value, and after I sell them, the stock goes up a few 100%. So I made this mistake a lot, but then I stumbled onto a book called 100 Baggers by Christopher Mayers, and he actually says, why would you go and buy a stock below fair value, sell it at fair value, pay the taxes, and find something else? If you could do the work one time, buy one or two or a few exceptional companies, or a few of those potential 100 baggers, you only do the work once. You keep up with the earnings report, and the stock will take care of itself. And even if you buy 5 of those potential 100 baggers, 4 of them go to zero, but only one goes up 10 or 20 or 50 times, then this is all you need to have life-changing returns. So there's a lot of asymmetry to this strategy, and this is what attracted me to this strategy in general. But the book mainly talks about stocks that went up 100 times over the last 25 or 30 years, and it's mainly a study on some common attributes that led them to go up 100 times. And I'm going to talk about some of those attributes in today's video, and then I'm going to tell you a little bit about how I found Mama and things I look for and all these kind of things. Now, the first thing he talks about in his book is mainly buying smaller caps. Although now it's not as important because we have inflation, so you don't have to buy a micro cap. Like when I bought Mama, it was 65 million market cap. You don't need to do that today. You could buy 1, 2, 3, 4, potentially up to $5 billion market cap, and you could still have the potential for the stock to go up 100 times over the next 10, 15, 20 years because of inflation and things in general. So I would say a few $1 billion market cap is something that's likely to give you this potential, because it's always easier to get those numbers if you're starting from a smaller base. The second one, which was a very interesting one to me, and it was really against everything I learned in my investment career, is that those stocks, they will trade at their 52-week highs most of the time. And reason why they would trade at their highs is because the market is rewarding them because they're doing something right. And if a company keeps on making new lows, it's likely not the best company, and it's likely doing something wrong. Now, I'm not saying the market is efficient. I love buying discounts. I love buying stocks at 52-week lows, and I still buy stocks at 52-week lows. But if you look at Apple, you look at a lot of those stocks, they will spend most of their times near their 52-week high because everyone realizes that this is an amazing company and it likely deserves some kind of a premium, so it's much stronger than other stocks that keep on making new lows. So the old me would skip a stock that's up just because I believe I'm late to the party. But after I read this book, I'm like, I don't really care much about that. Maybe the market is realizing something, so I'm going to focus on the value. As long as the stock is not expensive, then I'm going to be interested in potentially buying it, despite how much the stock is up over the last year or over the last few months. Now, the third one, which is by far the most important part of this entire book, in my opinion, is it's called the twin engines. So most investors, when they look for growth stocks or multi-baggers, they focus on growth. And growth is very important because if you have a company that goes up, I think 22 or 25% a year in revenues for 20 years, and everything remains equal, margins, multiple, everything, you're going to have like around 100 baggers. I believe that's the math around it. But growth alone is not really important. What I believe is also important, and this is what I had with Mama, was mainly a multiple expansion. So when I found Mama, I had the growth, and I was buying the stock at about 14 times earnings. That doesn't happen very often. Since I bought Mama, I was never able to find another stock where I'm like, okay, I'm getting the growth, and I'm also getting the potential of a multiple expansion. It was a little bit like that with Ouster. I bought it at 5 times sales, growing sales 40%. Now it's trading at 10 times sales, so I had that a little bit. But with most stocks, it's really hard to find both the twin engines, which is growth and a potential multiple expansion. If you look at Walmart, Costco, all of them, they were trading at single-digit PEs, and over time they got an expansion to like 40, 45 PE because the market was rewarding them for consistency, and they also had the growth and the return are pretty amazing. But you should not, and you should never, I think, pay up for growth like maybe a stock that's growing earnings or revenues, I should say, I don't know, 25%, and you're paying 40 or 45 times sales, you're most likely going to get in trouble. So it's always good to be on the lower side of the multiple. And I try not to pay much more than 10 times sales for any companies that I'm buying, especially a growth company. Now, something else that's important is insider ownership. So you want the managers to have skin in the game. You want their incentives to be aligned with your incentives. Now, some companies have a lot of stock-based compensation, so they don't have high insider ownership, like Palantir and others, and that's okay. In this case, you would have to look at the proxy statement, and you could see the proxy statement normally below the annual report, and go ahead and read it, or maybe use ChatGPT to help you read the proxy statement, and it would tell you the management's incentives on how they're getting this compensation. Is it based on long-term incentives, a certain sales milestone, certain sales growth targets, or is it based on short-term incentives that are very, very easy to achieve? If it's based on long-term incentives, then even if they don't have, you could say, insider ownership, even if they're selling, they still have the incentives with your incentives to do really well for the company. So that's something that's very, very important. And it's something that I also had with Mama's Creations when I first bought the stock. Now, something else that's also important for me is I don't want to buy a stock that's never going to be profitable. Like Archer Aviation or Oklo, that's not going to be profitable before 2031. Or the quantum stocks, which I believe they're in a bubble and they will never be profitable because you're going to be diluted to the stratosphere. They're going to have to issue shares to fund the operations, and you're going to be diluted as an investor, and that's really, really bad. So I try to buy stocks that are profitable or within 1 year of profitability, and that's really, really important. Now, how did I find Mama's Creations? Every Saturday or Sunday, and every weekend pretty much, I go on finviz.com. This is a free screener. You don't even have to pay for it. You just go on the website. I don't even have an account. It's free. It's all free. And you go on the technicals. I put in 0 to 5% above the low. And that's mainly a screener that I use to find turnarounds and value investments. I still use a screener. So I look for 0 to 5% above their 52-week lows. And I also look for a company that's profitable, and I screen them by sector. So this is communication services, this is cyclicals. I try to avoid cyclicals. Whenever I was looking at Mama, it was in the food and defensives category, which I like because I know that if we have a recession, we have inflation, the company will still do well because everyone needs to eat. So food is more necessity than some kind of a boat company or some kind of a lumber company that's trying to be a compounder. So I always prefer a company that's a necessity-based industry. And this is what Mama was within the food sector. Then I started researching the company a little bit more. They had a new CEO, and I only had 1 quarter with the company. And I was very interested because I know once you have a turnaround and you have a new CEO, you have a new face for the company, you have a very high likelihood of being able to change something. So you always want to try to find something new with those companies. Maybe a new product that came out that could be a game changer. Maybe a new CEO that's going to be a game changer for the company. You always kind of want something new, especially if the company was dull and there's something turning around it. That's normally a major catalyst. And this is what I found pretty much with Mama here at about $1.74. It was actually up when I bought it. It was trading at $1 before, and it went to $1.74. It was up like 60% in 6 months. And normally I would skip the stock because I believe I'm late to the party. But then I realized that the stock was still cheap, and I decided to bite my tongue and buy it. But the old me would never bought it because I believe I'm late. But since then, I never skip stocks that are up. I just look at the fundamentals. But I did that, and I found a stock at $1.74. It was actually trading, after I bought it, was trading near its highs. So I found it at $1. Then when I was analyzing it, it went to $1.70, $1.74. And I just decided to bite my tongue and jump in the company. And I bought a little bit more over time. But what really got me interested in the stock was the earnings call. And this is something that's really important because a lot of newer investors, and again, don't get mad, but they're a little bit lazy, They like looking at the AI summary on Seeking Alpha or AI summary for some earnings call. And there's nothing wrong with that if you're actually invested in the company. And you know the company well, you know everything around it. Nothing wrong with looking at the AI summary. But if this is a new company that you're investing in, you have to listen to the earnings call because you want to feel how energetic the CEO is. Is he actually passionate about the business? Look at his body language. Look at how he's moving his body. Look at his, kind of try to hear his voice. Try to hear his voice in general. That could tell you a lot. If he cares, if he has a lot of energy, if he's enthusiastic and excited, or is he half asleep on the earnings call and he's like, yeah, whatever, we're going to try to do something. And a lot of companies are like that, and I don't invest in those companies. But this CEO, the CEO of Mama, if you watch any of his interviews, you'll be sold on the company. I'm like, if the CEO ever invests in a company, I'm going to be buying it. And he really explains to you how the old management team was messing it up. And the way they were messing it up is they were going to a store like Kroger, for example, or any kind of Publix, for example. They have 3 different products. They use 3 different trucks for those 3 different products. He's like, that's really stupid. Why don't we put all 3 products in one truck and deliver them at once? We would cut the logistics cost by about 50 to 75%. And a light bulb went up in my head. I'm like, that's such a simple idea. And they weren't even able to do that. So when I listened to him and I listened to how enthusiastic he is, I decided to trust him and I invested in the company. But if I hadn't listened to the earnings call and I just read the income statement, I would have never invested in the company. Which is why, guys, it's very important to, listen to the call, try to hear the tone of the CEO. If he's enthusiastic, he's excited, how he answers question when he's being challenged. Does he panic or he actually answers them with confidence? All those things are really, really important, and they can be tells to a lot of things. Now, the other thing I did with Mama is I actually never trimmed the stock from $1 to $16. Only when it got to $16, then I trimmed the stock about 10% of the position. But I let my winners run, which is something I never used to do because I believe the stock is up. I have to take profits in case the stock goes down. But I don't focus on those things anymore. I focus on my long-term upside potential. So if it hasn't reached this upside potential and my fair value on the stock, why would I be a seller? Just because the stock went up? That makes no sense. So with a company like Mama, it was very simple to me. The way I was calculating it, again, I take the $1 billion in sales, which is the CEO's target by 2030. He also guided 10% net income margin, which is typical for a food company. Okay, now you know what the number is. It's about $100 million in net income. Those kind of food companies, they trade between 15 to 20 times earnings. And for a growth company like Mama, I would argue it should be higher than 20 times. But if we use 20 times earnings as a multiple, this is a $2 billion market cap. So even after the stock is up 1,000%, it's still trading at $800 million market cap. So the stock can still double over the next 3 to 4 years if the CEO delivers on guidance. If he doesn't deliver on guidance, then, maybe things could shape up. But still, the stock has still a lot of upside. So when the stock was going up from a 65 million market cap to 200, 300, 400 million, I wasn't taking profits because it was up. I was focused on a $2 billion market cap. And it's the same thing with a stock like Ouster, where Ouster, I trimmed it, but I didn't sell it because I know the stock has 10 to 20x potential over the next 10 years. And I'm like, I either want the 10x or I'm happy selling the stock at break even or selling it at a loss. I either want the big price or I don't want anything. I don't want to trim for 50, 20% gains. I invested for 10 to 20x. So either I'm going to get it or I'm not going to get nothing at all. And this is the mindset I have for those stocks, where I size them small enough for me to be able to do that. If I have a bigger position, then I'd be more enticed to do something. But if it's a smaller position, I'm like, I bought it for a 10x. It's up 2x, it's great, but I'm here for a 10x. Once I get that, and the fundamentals are supporting it, then we talk if I sell the stock or do something. But if it hasn't reached it, I don't care. I'm not settling for less. I'm going to leave it for whatever I believe is the company is worth. So this is how I look at those things. This is how I value them. And those are the things I look for. I would recommend you, looking at the book, 100 Baggers. It's not promoting me. I don't have an affiliate link, but I found it really helpful. And if you're interested in such stocks and more ideas, which I bought another one recently, other than Ouster, that has a lot of potential, but a lot of risk as well. I share everything I do in my group, and this is the link if you're interested. But thank you very much for watching. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.